Ticker News with Aaron Young. This is Hot Shots.
Hello and thanks for joining me. Donald Trump is back focusing on tariffs once again, this time warning other countries that if they impose tariffs on the United States, then they too will cop it even worse. So what does this mean for European nations and countries like Australia? Should we be preparing for a tariff war? We'll be joined by Kyle Rodder from Capital.com to discuss in a moment. Plus, inflation is coming down to within range in Australia, though many essential goods are still sky high. So will the RBA finally move on rates next week? And what is the Fed waiting for to cut rates this year in the United States? I'm Aaron Young. Let's get started. President Donald Trump has unveiled a sweeping plan for reciprocal tariffs targeting foreign nations. The initiative aims to impose tariffs in response to those that foreign nations and countries that impose US imports. Now, Trump indicated further tariffs on auto imports may be in the pipeline. The president continues to push a pro quo line. If they charge us, then we charge them. We're joined here in the studio by Kyle Rodder from Capital.com to discuss. Great to see you.
Good morning.
Another exciting day from Donald Trump. It feels like every day there's something new. What do you make of reciprocal tariffs?
Yeah, they've been in the pipeline for a little while, and the markets have been very, very attuned to obviously the trade war over the last 2 weeks, especially after the kind of, I guess, shock factor of those Canada-Mexico tariffs, which were obviously put on pause and have been for the last couple of weeks. The markets have more or less prepared and positioned for the fact that we are heading to an environment now where, if it is for sort of a greater purpose, a negotiating tool to achieve something else, or whether it is really to change trade relations with trading partners, that these tariffs are going to be applied at some level, and that we should be effectively pricing that in and preparing for it. I think what the markets have actually been quite happy with is that it's quite a considered approach. The developments of the last 24 hours was that, we'll see the Secretary of Commerce more or less put together a package of ideas country by country as to what those trading partners are doing and what tariffs should be applied on them potentially, if at all. And that kind of measured and considered approach, especially compared to the first Trump administration, is different. It's, again, much more thoughtful. So market participants are preparing for a trade war, but they're sort of hoping for the best, so to speak, and certainly thinking that there won't be perhaps quite as many shocks as previously thought.
He talks about reciprocal tariffs for unfair countries with unfair trade practices. Obviously, Australia isn't one of them, but we have been caught up so far in the steel tariffs and the aluminium tariffs as well. Is this going to be a one-size-fits-all approach, or is Donald Trump essentially saying, if you harm us, then we'll harm you back? But how do you do that without them bring in their own reciprocal tariffs in response, and off we go?
Yeah, and that's the biggest fear for the markets, broadly speaking, is a
tit for tat
dynamic emerging, because it's a bit of a race to the bottom. It has to be said, I think Trump's view on trade is probably not what you would describe as perhaps economically literate. He sort of sees basically it as sort of a zero-sum game, where if someone is buying your exports or you're buying someone's exports, you're giving them money for sort of nothing in return, which isn't necessarily true. There's kind of second and third order effects that one must consider, which has sort of blowback consequences on the economy, and we've obviously spoken about that in the past. But I think one thing that the markets have actually embraced in the last 24 hours, going to your point about potentially getting kind of caught up in all of these things or being sort of collateral damage in a way, is that the project put forward by the Secretary of Commerce is specifically looking at how each country trades with the United States and then applying trade sanctions, whether they be for the right reasons or not, on an individual and case-by-case basis. So although we could still be caught up in a potential trade war, we had obviously over the last few days, I think it might have been Lighthizer or somebody else, I can't remember, talking about how Australia's killing the US aluminium industry. At least we'll be sort of judged on our own merits, and we won't be sort of caught up with things. And it means caught up in just sort of a broad-based universal tariff, which means that our government can come to the table a little bit and say, as we've already heard in the last week or so, hey, you've got a trade surplus with us. We're a strategic ally. Don't slap these on us. It's not in your interest. It's not in ours. Let's do a deal. So that, again, is a positive development. It doesn't necessarily mean it's going to come to fruition, but it's that sort of, again, much more measured, tactful and delicate approach relative to Trump's normal sort of bombastic ways that have investors hoping that, again, the impacts won't be as significant and there's a bit of room for manoeuvring and negotiation here.
The only issue there is that you say, let's make a deal, and that seems to be what he is aiming for. The problem with that is that there are 200 countries that that you have to make a deal with. The US trades with everybody, basically. Therefore, it feels like there could be room for a bit of a mistake here because there's just so many deals to be done, and it would be so complicated. He's talking about VATs, he's talking about non-tariff barriers will be treated as trade restrictions. A lot can go wrong in that sort of negotiation.
Yeah, this is where things get a little bit funky, and I think probably the detail that market participants were a little bit caught off by last night was especially when Lutnick was talking about, a value-added tax as being considered pretty much a subsidy for exports and what have you, and that was something that hadn't really entered the conversation up until this point in time because everything was basically focused on, again, Trump's sort of zero-sum attitude towards sort of surplus deficit, we win, you lose, and that was kind of simple as that. Now it would seem that the trade war, or at least tariffs, are going to take a much broader view of things, and that goes into sort of subsidies, the value-added tax that you're talking about, and then even as well some kind of measures, antitrust measures. For example, China has retaliated to the initial tariffs applied on them by reviewing Apple and its sort of trade practices within the country, threatening perhaps the market, its market share in that economy. So it's taking a far more complicated and potentially a sort of a Byzantine kind of shape, which is not a good thing because, like you said, it raises the risk of a policy error. That creates a level of ambiguity. Again, the markets don't seem to be worried about that right now, but it's certainly something that can kind of risk blowing up at some point in the future. Something worth being concerned about.
For Europe, this could be a disaster. Obviously, Germany is in a world of pain at the moment for a multitude of reasons. France and Emmanuel Macron seem to be the thorn in the United States side, which is often the case when it comes to Republicans in the White House and the relationship with France here as well. The EU warning that they will retaliate.
Yeah, and I guess they will have to. And this is the thing, is that, really you have no choice but to respond in kind. It's, a little bit of a game theory sort of situation where if, more or less your ally in this situation is looking to get an advantage over you, you are sort of more or less forced to retaliate in kind. Because you will be, worse off objectively if you don't. So, there are talks at the moment about the value-added tax in particular. That was sort of pointed towards European countries mostly. That this kind of complicates things, but also automakers and tariffs on autos as well, which is another one that Trump has discussed quite significantly. So, the major industrial countries in Europe are under threat from this. If the tariffs are applied, they will have to respond in kind. But again, this is the problem: is that the US has the leverage in the situation. And although it is beggar thy neighbour, the US is kind of, cutting its nose to spite its face with these sorts of policies. They will still ultimately at least be the winner on a relative basis on this, and Europe just has to kind of, unfortunately, play ball, which is, again, we're all going to be poorer for.
Easier said than done.
Yep.
Now, the overall inflation rate has significantly improved, easing the strain on consumers and on business. With an interest rate cut expected next week, there seems to be some more good news on the economic front. The Reserve Bank of Australia's recent data shows inflation now 2.4%, comfortably within their target range, providing hope for continued stability ahead. So will they or won't they cut rates this time? What do you think?
I think they will, and really on the basis that they haven't said that they won't up until this point in time. And the reason for that is effectively we've had a spate of data recently that has shown that inflation is kind of slowly returning to target. Obviously on a headline basis, it's back in the mid-2s. When you take out those energy subsidies from the government, it's in the low 3s, and suggestive that things are starting to trend towards that kind of 2 to 3% target band on that crucial trend mean figure. When you combine that with obviously clear signs that the economy is weak, it gives the RBA fair impetus, markets, a fair reason to believe that rates will be cut. The reason why I think that they will do it because of this recent data is that there's been no commentary since that CPI release at the end of January to push back on market pricing. Now at about a 90% probability that it will cut next week. So the foundations seem to be set there for a rate cut. There can be arguments as to whether they should do it or not, but based on, again, the evidence here, it seems that they probably will.
The evidence in Australia, but no doubt they'll be looking to see what happened in the United States after the emergency rate cut last year of 50 basis points, because then you see that inflation started to trickle up again in the US. Will the RBA be worried about the message that a rate cut would send to the market, that they end up back in the same spot?
Possibly. I mean, if you do look at what's happened in the United States, and arguably the rate cuts we've already seen has helped sort of support the labour market, even in the last 3 or 4 months, which would be a fairly quick response to rate cuts in an economy, but it's not impossible to envisage. More or less that the 100 basis points of cuts that we've had from the Fed since, what was it, September last year, might have been a little bit too extreme, and we're certainly likely seeing the Fed on pause now for an extended period because inflation is sticky, as we saw this week, and the labour market is still really strong. In Australia, the circumstances are a bit different because the demand environment in the United States, even when we did see that kind of slight labour market shock, was really quite strong still. We're not dealing with those sorts of pressures. In fact, the RBA has told us extensively over the last 12 months or so their concern is more with the supply side of the economy and trying to bring things back into a balance a little bit. So,
well, speaking of the supply side, wages rose 11.2% in 3 years. Essentials like gas, insurance, and if anyone's gone to the supermarket, eggs are all up about 40% as well, and some things continue to increase. Talk to us about whether that will play into what the RBA is thinking.
It's a hard one because this is when you start talking about the differences, and I have this conversation extensively, especially in the office with guys who are trying to digest the impacts or the reasons for Trump's election, which was basically an inflation vote. People were unhappy with the economy.
But now it's his problem.
It is his problem. The point is, though, is that there can be a difference between what the data tells you and people's perceptions or people's experiences. And the thing is that when you do look at what the RBA tries to track in setting policy, they're trying to strip out a lot of those things like energy and food, which are very noisy and they can't really control, and look at some of those underlying pressures that they can and adjust policy accordingly. So even if they do lower interest rates, it probably won't won't solve the issue with perhaps energy markets, which you can't control. It won't necessarily solve problems relating to sort of food prices. Those things that when you look at the bottom, when you look at sort of the distribution of how inflation impacts people, those kind of necessities, the prices are still going up, and putting pressure on those households. But the RBA can't really solve that with an interest rate cut. So on the one hand, the RBA will be obviously fairly cognizant of these issues because it always acknowledges inflation doesn't impact everybody equally, but at the same time they can't really do much about those sorts of things, and unfortunately it means that these things won't be solved with an interest rate cut, or certainly a 25 basis point interest rate cut in the short term.
All right, well, Fed Chair Jerome Powell has indicated that there is no rush to cut interest rates in the US as the economy remains stable. He played up the importance of monitoring inflation closely while maintaining current rates for now. Looking ahead, Powell suggested that rate cuts could happen if the labour market weakens or inflation declines rapidly towards the Fed's target.
The Federal Reserve remains squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. We are attentive to the risks on both sides of our mandate.
Well, I think when it comes to regrets, he's had a few, but would the cuts last year be one of them?
Time will tell, possibly. I mean, again, the situation last year...
this was an emergency. This was a huge deal. This was panic. We spoke about it back then, and we believed that there would be 4 rate cuts this year as a result.
Yeah.
Very unlikely to happen.
Yeah, the markets were pricing that in at one point, and I think the Fed was fairly measured in its approach when that surprise in the data started coming through, which suggested maybe some deterioration in the labour market. Arguably, some of these rate cuts, although again the transmission of those rate cuts in the space of 3 or 4 months would be pretty quick by historical standards. We talk about long and variable lags. It takes a while for rate cuts normally to impact the labour market, but arguably it has had some kind of an impact since then in hiring conditions. The point is that, yeah, maybe the Fed has cut a little bit too aggressively, especially considering the state of the US economy, and now it's kind of trying to pull things back a little bit and play a wait-and-see approach. I mean, it's very easy to criticise because it's not an easy job to be able to predict these things.
I was just about to say, imagine being the Fed trying to make decisions when Donald Trump is launching executive orders that can directly impact the decisions that you're making and the economy. It would be impossible to try and predict what will happen and what the ramifications of your decisions could have.
Yeah, without a doubt. And I mean, going back to the previous point, the US economy has proven to be more resilient and much stronger than previously thought. Didn't probably require the 100 basis points of cuts potentially. On top of that too, with now the fact that we're seeing inflation a little bit sticky, the employment situation is still fairly solid. You've got all of these potential shocks and inflationary tailwinds coming through, both from tariffs as well as potentially very loose fiscal policy from the Trump administration going forward. too. And there have been questions in the testimonies that we saw in the last couple of days, certainly from the press at the last Fed decision, about how are you trying to model the impact of Trump's policy decisions. Some Fed members have suggested that they're already taken into consideration and trying to estimate these things. Powell has very much emphasised taking a wait-and-see and data-dependent approach. If it manifests in the data, then we'll respond to it, but we're not going to preemptively move on the basis of it. And so now, especially given that they have the data there to justify basically keeping things steady, that the economy, at least when you look at the big aggregate numbers, is looking really, really solid, they're saying, well, we're just going to wait and see.
Some economists are predicting that rates in the US will stay high because of the amount of different factors that are out there at the moment.
Yeah.
And also that obviously Donald Trump is trying to boost the economy. Therefore, that would send things sky high once again if people can spend more, right? Do you think that they envisage a scenario where rates could actually increase in the United States?
The markets aren't pricing that in, and they're not talking about it yet. They're still sort of expressing a level of confidence that inflation will continue to moderate towards their 2% target in the next couple of years. And one of the things they're trying to do is that they're not trying to slam the, and the RBA tried to do this as well. They're trying not to slam the brakes on the economy too much to get inflation back to target, because it's going to come at the expense of the labour market. But what we have seen, and this is probably the concerning things over the last few days, is that the markets are pricing now that the federal funds rate will be at around 4% for the foreseeable future. Maybe we'll get a cut at the end of this year. And the other thing that happened last week was that we got some consumer inflation expectations data, which showed about a 100 basis point increase in one-year inflation expectations amongst consumers, which is normally, not normally, but can be a bit of an indicator that those prices are losing their anchor around current levels and could be poised to increase in the future. And if that starts to happen, that's when the conversation probably starts to be had that, maybe the next move could be a rate hike. Again, we're not seeing that in the evidence in the data just yet, despite a bit of a jump in CPI figures that we did get this week. But it's a possibility. It's not considered the most likely outcome, but it's a risk people have to be attuned to, especially because of the current policy settings, as well as the surprising resilience that we've seen in the US economy.
And just finally, what do tariffs and a tariff war do to US inflation, up or down?
Price shock initially. So we try and distinguish between inflation and price levels. One is a one-time price shock, so the price level increases, which increases inflation in the short term, but it's not sustained because inflation is defined as a continued increase in the rate of prices rather than, again, just a one-off change to that level. But the problem is that either we get consistent tariffs coming through, which means that there's this kind of drip feed of tariffs impacts on inflation over time, again, kind of smoothing that out, but also causing this kind of inflationary dynamic somewhat artificially. The other fear, and this goes back to what we were talking about before, is that if it starts to impact inflation expectations, this kind of vicious cycle of people thinking prices just continue to move higher. That's why there was that shock on Friday night because of the inflation expectations figures from the University of Michigan survey. That's when things become actually inflationary. So in the short term, and probably it just means one-off price shock and then a growth drag. But again, if it starts to feed into this kind of vicious cycle dynamic, then it could be truly inflationary.
Carl Roden, Capital.com. Always appreciate your time. Thank you.
Thank you.